I think if you are to look at some specificities of the UK, I think the labor participation, the low labor participation driven, according to surveys, by a lot of people reporting to be sick, appears to be a bit of a unique feature of the UK economy, which arguably has constrained supply and ultimately boosted wage inflation. But again, I'm not sure we should attribute too much importance to that. As I said, I think in part what we're seeing in the UK is big increases in energy and import prices, like in Europe, which are leading to a lag in the disinflation process, especially in the goods sector. You had later reopening from the pandemic, which again leads to a lag relative to the US. And I think compared to Europe, you're right that the labor market here is tighter. But again, we are seeing some incipient signs that things are changing. Vacancies appear to be slowing. We're seeing some signs that unemployment is turning a corner. So I would expect wages to moderate, and perhaps there is some extra supply side pressures on inflation, but I'm not sure the UK inflation trajectory is on a completely different path compared to the rest of the global economy.
Okay, so disinflationary trends in place. Let's talk about the growth side of things. More and more, it feels like people are turning optimistic about countries' abilities to avoid a recession. We hear about it in the US, UK sort of skirting around a recession as well. Is it your view that despite all of the monetary policy tightening we've seen, major economies will be able to avert the worst case scenario on the growth side?
You know, our view remains that the global economy and the US economy will go into some kind of mild recession at the turn of the year. I mean, there is no doubt that the recent data have raised the chances of a so-called soft landing or immaculate disinflation, which is where inflation kind of moves towards target without having a contraction in activity. But in our mind, there have been things that have mitigated the effects of monetary policy and bank lending, that tightening in bank lending standards, including, for example, excess savings in the economy and the fact that loan and bond maturities have been longer compared to before. But we think ultimately the weakness is coming. We studied the lags of monetary policy to activity over time, and we found that generally speaking, the peak impact on macro of monetary tightening tends to be around 18 months after the start of the hiking cycle. And in the case of the Fed, that would mean that towards the end of the year, we're going to get to the peak impact. I also think that to really get inflation down to 2%, you probably need some loosening in the labor market. And so the central banks will keep policy tight to ensure that inflation ultimately moves towards 2%.